Your supply chain can make or break your business. With Global Trans, you have the advantage of innovative logistics technology, expansive solutions and carrier network, and a partner committed to your success. Global Trans, freight driven by technology.
Welcome to Off the Supply Chain, a show for shippers. If the supply chain is all about cooperative competition, so is our show. We're bringing you compelling perspectives from 3 industry experts. It has been more than a decade since the Great Recession. In a lot of ways, the economy has bounced back. But according to a new survey, more than half of Americans fear we are yet again headed into a recession. In uncertain economic times, this brings up the topic. Is there such a thing as a recession-proof business, or can a business only set itself up to have a better chance of outlasting a financial crisis? We debate these topics and many more on this episode of Off the Supply Chain. Now to your host, Chad Prevost.
Joining us today on the Great Recession Debate, Anthony Smith examines macroeconomic trends and their potential impact on the transportation industry at FreightWaves. As an economic consultant, he's forecasted industry trends for Fortune 500 companies and advised executives on how to navigate market downturns. Strickland analyzes and reports on transportation industry activity and statistics for FreightWaves. As a financial and pricing analyst at USXpress, he saw his company through the last deep U.S. economic recession. And JT Engstrom serves as Chief Strategy Officer at FreightWaves. He was a top-ranked equity analyst by Institutional Investor and Reuters for multiple years. Here are the rules of the game. Each guest gets 40 seconds to respond with a 30-second follow-up. And this is, of course, the supply chain show of competitive banter, so we keep score. When you hear this sound, you have 10 seconds. When you hear this sound, you are out of time. This sound means you get a point, and this sound means you lose a point. Let's go to Emily Zink for our first question.
Tom Goldsby with the Haslam College of Business at UTK says right now we're marking the 10th year of a steady economic climb. Inevitably, we'll see some colder economic times. Goldsby believes a company can be recession ready, but never recession proof.
When a recession does come, hopefully it's not going to be a long-lasting one. It's not going to be particularly deep. But smart companies are those who are taking the efforts within their 4 walls that they can take, but increasingly looking to the end-to-end supply chain about opportunities and to not only brace for the inevitable, but maybe even find opportunities to grow the business even during a time of recession.
So, do you agree with Goldsby? No company is 100% recession-proof, but there are companies that are smart and recession-ready? Or do you disagree with Goldsby? Anthony?
No company is fully recession-proof. There are some industries that are recession-resistant. These are industries that are facing, publicly facing potentially, that are maybe government mandated, that require you to have something done maybe by law. But no company is fully recession-proof. This even goes further that when there are times of cyclical recession on the greater economy, there are still some companies that are counter-cyclical, so they don't move with the traditional economy. So not only is there not a fully recession-proof industry, these are faced with competition. So maybe there's a barrier to entry that really limits the amount of actors in certain businesses.
What do you think, Zach?
Yeah, no, it depends totally on the type of recession we're having and how long the recession lasts. I mean, you can't just say that everything is not recession-proof. There are certain businesses like Walmart, the dollar stores, all the sins like alcohol and cigarettes actually boom up, and lottery spending goes up during recessions, which is impressive. So, I mean, you can't say that things are necessarily recession-proof, because the length of the recession itself will eventually show up, even in the Walmart chains. So it's it's a very analogous question. It's not necessarily a direct answer.
JT, how do you want to tackle it?
I would say that the best performing companies in our economy are the ones that actually plan for recessions and make sure they have the balance sheet capacity to be very aggressive at trough and start purchasing out competitors, opportunities, new customers, and strategically allocate capital so that when the cycle does turn, they can materially increase the return on invested capital. And furthermore, there are some businesses, as Zach alluded to, that expose themselves strategically to industries that have much less volatility around recession periods in our space. The Keenan Advantage Group is a really good example. And they've traded in private equity pretty recently and did incredibly well in 08 and 09.
Well, JT, what are some companies that do the very things that you were just describing?
In terms of allocating capital strategically, you'll see that FedEx purchased roughly 26 767s in 2011, and that was roughly a $2 billion transaction and materially below current market value for 767s. So they were able to expand their fleet and connect Memphis with Shanghai at a pretty affordable rate, and that had material impacts on their network throughout now. Those are 20-year long-lived assets, and they continue to benefit the network.
Zach, can you think of industries that really could be recession-proof, regardless of the length of it?
Yeah, I mean, there's certainly industries out there that have lower limits of exposure. The insurance companies, for instance, healthcare, they're very recession-resistant because these are things that are always in demand. People get sick. The aging population is still a thing. So as long as that exists, I mean, there's no limit to how much people will be able to spend on healthcare and insurance.
What do you think, Anthony? Any recession-proof industries that you can think of?
Industries I can think of right now are things that are public-facing, so things that you have to get done by law. So if you're looking at home repairs or things that you need to get done in order to sell a home or buy a home, or maybe you need to get a car repair. So these things are maybe recession resistant, but still that barrier to entry is going to be difficult, whether it has to be something that you need to be registered for or predisposed to because you need to have certain licenses in place.
And at the end of one round, the score is Anthony 5, Zach 6, and JT 5. The Federal Reserve recently lowered its benchmark interest just shy of 2%, down from the 2.25% it was at. In an unusual move for a president, President Trump, just minutes after the announcement, slammed the central bank as having, quote, no guts. What did the small adjustment mean? Zach, you ready to tackle this one?
Yeah, no, this adjustment really didn't matter that much. I think what they're trying to do, what the president's really trying to do is stimulate the spending. And that's already been done. We saw a lot of accelerated depreciation laws go into place last year. People were already spending a lot of money in 2018, which we're seeing a big hangover effect of that. And saying that you can save another 0.25%, that's not going to stimulate anybody to spend more. They just spent all their money last year. So it takes a minute for people to really, get their self back together after they've gone on and overextended themselves in the previous years. It's just a natural contraction.
JT, what do you think about this small incremental amount?
Yeah, I think quantitative easing is a standard tool of monetary policy used by the Fed. And I think the 0.25 point, while nominal in terms of raw interest rate, is actually really symbolic of their ability to be dynamic, both increasing and decreasing rates throughout a cycle. I think what's more important actually is the equity risk premium, which right now is roughly 2% in relation to the 30-year Treasury. And as a result of the Fed manipulating the money supply, which is actually directly interrelated to interest rates, it influences both the equity risk premium and asset inflation or deflation, which is, of course, where we've come out of from 2009.
I think that sounds like a good thing. What do you think, Anthony?
I don't think this is essentially textbook quantitative easing. I think this is something that is an overreach for the Federal Reserve. I think this is something that is going to be one less tool that we have in terms of a true economic downturn. And it's really telling me that there are potential reasons for worry when we're looking at actions that are being taken by the Fed right now.
Well, should there have been a bigger adjustment or none at all? What do you think, Anthony?
I think no adjustment at all, because what we're doing is we're using a tool in order to get an outcome that we want. And so whether that might be consumer spending or spending overall, as Zach mentioned, or maybe trying to manipulate inflation rates, the thing is that there's so many variables and that this one thing has implications on many different areas of the economy. And so it's really a hammer when maybe you should have used a screwdriver.
Oh, what do you think, Zach?
No, I don't think there's much else we could have. I mean, there's nothing to do to stimulate more spending other than we're at a natural low point in the consumer spending cycle. Technologically speaking, we've reached kind of that pinnacle. You know, the PC back in the 90s stimulated the economy. A lot of software companies stimulated it in the early 2000s. You know, we just don't have that reason to spend as much as we used to. And with housing spending going down, that's also going to have a contractionary effect.
Great points. Well, overall, I know you said you do think it's dynamic and quantitative easing, JT, but should it have been, do you like the size of it? Could it have been none at all or go bigger?
I like the fact that they cut interest rates. I don't think it necessarily should have been larger. I think if you're going to go up a quarter point, going down a quarter point is also appropriate. The forward PE on the S&P 500 is trading at roughly 22 times, which is 1.5 turns below what it had been for the last 2 years of the Obama administration. And so directly linking interest rates to that premium, you know, the 22 times is roughly a 4.5% earnings return, or yield rather. So I think that makes a lot of sense.
And at the end of 2 rounds, we have Anthony with 9, Zach with 12, and JT with 12. There has been a lot of chatter about the current health of the U.S. economy, and even indicators our country could be headed towards a recession, perhaps in time for the 2020 election. The key to whether or not the U.S. economy keeps growing or stalls depends largely on the consumer. So far, consumer spending has held up well, which is not surprising because of the low unemployment rate. We know how much the consumer drives the spending train and therefore keeps the economy chugging along. What are factors we look at besides unemployment that impact consumer spending? Any early indicators? JT, let's start with you.
We certainly like looking at truck volumes because it's indicative of what the consumer is actually, purchasing and consuming. Now, the challenge with 2019 right now is we have a really challenging comparison with 2018 because it was such a good year. And so to say that 2019 is a weak year as a result of that is really not fair. We're seeing a lot of volume moving through truck. We also look at consumer sentiment, which has been which is a survey-based rate and has not performed well this year, but I think it's largely based on the comp from 2018. Housing starts are really strong this year, which is important.
Zach, what do you think?
Yeah, I think consumer sentiment is total garbage. I don't think you can really look at any kind of survey data like that and get any real necessary information from that. They're still spending money. Retail is still going pretty strong, relatively. It's not, I look at obviously trucking volumes and our data platform and our data, but I also look at other things like the ISM, the PMI, again, survey data, which has been historically weak over the last several months. And that's going to drive a lot of trucking demand, but it's still not the total picture because 70% of the U.S. economy is still driven by retail consumer spending. Anthony,
I know you look at the ISM and the PMI. What else do you look at?
Well, first off, I don't know what the heck JT and Zach are talking about.
Really?
Because first and foremost, when we're looking at consumer sentiment, it's still relatively high. Housing starts have not been as strong as they have been in the past, and so we've really seen a modulating effect when we're looking at housing starts because there's been supply side issues. The second part is that consumer confidence is a huge part, so I don't know what Zach's talking about because when consumers aren't confident, they're not out there making purchases.
But they're out there spending money right now.
They're out there spending money. And so the big thing that he's touting is PMI, which is essentially consumer confidence, but on the manufacturing side. So how confident they feel about the upcoming month.
Very good points. I hear you. Well, so what are some broad early indicators and why are so many experts suggesting 2020 may be a downturn, especially considering how quickly things change from one day to the next?
Well, I think so many people are considering 2020 to be a down year because there's so much uncertainty. And so that's what we're seeing so much on the ISM data, when we're looking at consumer confidence, when we're looking at the overall picture, we're seeing that there's a lot of uncertainty in the air. Even with preliminary deals maybe being reached, and maybe by the time you're seeing this, there's been a huge deal already reached. But the thing is that we're one tweet away from going back on all of that. So I think that uncertainty is really driving I think overall sentiment down.
Zach, we're one tweet away, lots of uncertainty. What do you think? Why are so many predicting this for 2020?
Yeah, there's just a lot of volatility in the market right now. We've got our president is tweeting things. The trade war situation is disrupting supply chains across the world, really. And there's not a lot of reason to be optimistic unless people can settle into what they're trying to do. They need to redesign their supply chains. They need to settle in and start spending money on their infrastructure, which they cannot do until they feel comfortable with the economic environment.
Fair enough, good points. JT, final word.
Yeah, there's certainly uncertainty in the market, and there's definitely less capital spending this year than there was last as a result of the fact that the tax bill had been passed in early 2018, late 17. I still think the consumer is incredibly strong. Discretionary spending's up. Unemployment rates are some of the lowest they've been in a very long period of time. Interest rates, whether they're up or down in the short term, are still very affordable for financing capital purchases on a personal balance sheet. And so consumers are definitely continuing to spend. I think 2020 will be a good year.
At the end of 3 rounds, we have a very competitive and close score. It is Anthony Smith with 15, Zach Strickland with 16, and JT Engstrom with 17. According to a survey by the American Association of Individual Investors, market optimism has been below average for most of the year and has trended down as the year has progressed. Big deal or little deal? Why or why not Anthony Smith?
I think it's going to be somewhat of a big deal, and this is only because when we're seeing that downward momentum is there in the marketplace, we're seeing these big headlines, and that can start to play into consumer confidence. And when they see that this metric is down, even has nothing to do with them, they might be less likely to spend.
Playing with consumer confidence, what do you think, Zach?
Little deal. Consumer confidence, like I said before, not a big deal to me, especially when they go out and see that little Prime button and start spending money during retail season. Little deal. It's not going to make a big impact overall. People are a lot more resilient to negative news than they were in the past.
What do you think, JT?
I think it's a really big deal because I subscribe to odd lot theory, and when retail investors are scared, I think it's a great time to invest, and when there's blood in the streets, buy real estate. I think it's an awesome opportunity to invest in the economy right now.
The man behind the inverted yield curve, Duke University professor Campbell Harvey, says the bond yield curve is flashing code red for a recession. Is this a big deal or little deal? Why or why not, Zach?
Yeah, I think this actually is a big deal because it's founded in facts and stats. So necessarily every time, I think the last 7 recessions have been predicted accurately when the yield curve is inverted for 3 months or longer.
Okay, JT.
I think it's a little deal, and here's another fact for you. 9 of the last 5 recessions were predicted by economists. So in reality, what matters more is the equity risk premium, which is now at 2%, and that's pretty healthy in relation to historical norms.
Okay. What do you think, Anthony?
It can be a little bit of both. Little deal because now it's starting to say, okay, this is what happened, and maybe there might be a recession in the next 2 years. Big deal because now it can start to play into investor sentiment and what they're going to do afterwards, and so it can be more psychological.
Okay, I am going to say can't have it both ways. Can't have your cake and eat it too, Anthony Smith. All right, topic 6, here is the final stretch. Financial advisors are setting their parameters lower on earnings based upon the new reality of the U.S.'s relationship with China and the ongoing trade dispute. Delta and Philips Electronics guided lower recently. Big deal or little deal? Why or why not, JT?
Little deal. The S&P 500 is up 18.5% year to date, which is really, really strong. Financial advisors should be happy because it makes their job very easy. Downward revisions on earnings are normal and expected 2 years, 1.5 years after a presidential cycle.
Okay, what do you think, Anthony?
I think this is a little deal, and I think we can start to use trade tensions and things like that as an excuse for what's really going on. And so you can just piggyback off of what's happening internally in your company and say that, oh, it's all because of what's going on overseas, and not instead of addressing what's really going on in your company.
What do you think, Zach? Final word.
Big deal because this is part of an ongoing trend. We're starting to see lower earnings continuously, and there's no end to the trade war in sight right now. I mean, we keep going through this back and forth with China, and we still haven't got a solution yet. So I think it's a big deal because we're going to continue to see this moving forward.
And then with a final score, Anthony Smith with 16, Zach Strickland breaking 20, and JT in his inaugural appearance making 23 points for this week's Off the Supply Chain Champion of the Week. Congratulations, JT. How are you going to spend your week?
I'm just going to have a blast, have fun, and maybe help these guys out a little bit.
Fantastic. That's what we like to hear.
Join us next week on Off the Supply Chain as we debate digitization. Our panelists include FreightWaves Chief Data Scientist Daniel Pickett, FreightWaves CTO Ken Smith, and innovation strategist at Covenant Transport Services, Matt McClelland.
Global Trans offers a full suite of solutions around logistics, supply chain, and transportation.
Technology is what we do. Global Trans is bringing the trucking industry into the 21st century. From a small family-run business to now almost $1 billion company. We did that all together as a team, and we're bringing the people, processes, and software together.
When I joined the company 3 years ago, I was attracted to the high growth and fast-paced environment, but I'm proud to say that we still have that nimble entrepreneurial spirit.
As a leader in logistics technology, our platform allows us to serve any market, any mode, at any time. We're at the forefront of the logistics market.
Our teams will always find a way to adapt to the best possible solution to service our customers.
Our team is here for our customers, literally 24/7 by 365, because we need to be, and we'll get it done anytime, anywhere. We have a very competitive team, and that's what we really enjoy doing.
Our mantra is simple: we are the future of freight.